Brian, it's great to see you here. So once again, we're looking at losses today. We got the jobless claims number out this morning. We also got some comments from Fed Vice Chair Lael Brainard. What did you make of what we're hearing from Fed officials over the last couple of days, and what that signals to you that we should expect in terms of policy?
Yeah, thanks for having me. So I think that when we're listening to the Fed officials, it almost sounds like it's listening to a broken record. And in fact, you can kind of look at previous speeches that they gave, and you can do this track changes thing to say, what did they really change with their statements? Not a lot has really changed. And I think that's just really symptomatic of the environment that we're in terms of they're just waiting for some more encouraging data. I liked Lael Brainard's comments, and I think she's a really important one to be listening to, because honestly, I think she's probably one of the smarter ones. I mean, they're all brilliant, but right, she's probably one of the smarter ones on the board, and she's a voting member. Some of the other people who are speaking, like let's say Bullard and even Collins, who spoke today, they're not voting members this year. And so it's always important to not only listen to what they say, but also ask, does their opinion really matter when it comes to setting policy? And I think Brainard is maybe more in the camp of let's hike once more, 25 basis points on February 1st, and then keep the option open to hike more if the data dictates that we should. So I think that it is about that data dependency, and they're just waiting to see, has this short-term trend in the decline in inflation, is that going to continue or not? We believe it will.
Good to see you, Brian. There seems to be a growing consensus that maybe at some point the Fed changes their target subtly to 3%. And you're hearing a lot of comments out of Davos that sound like that. Do you believe that will be the case, say, a year from now?
No, I think that the Fed, so back in 2012, January 2012, they really created this document about a statement of longer run policy objectives. And in there, they kind of codified, hey, 2%. The PCE inflation headline number, that's what we're trying to hit. And they revise that. They sort of reaffirm it, renew their vows to that pledge every January meeting. So that this next one, they'll probably restate that. But they don't really do a policy review to say, should that target change, except for maybe every 5 years or so. And so it's not even really on the calendar. I know a lot of people are saying, maybe they should take this as an opportunity to raise the target to 3%. But I'm not sure what sort of good that would do. In fact, it could actually be more disruptive to financial markets than if they just really affirm that, no, 2%, that's what our goal is, and we're not going to try to move the goalposts quite yet.
And Brian, another worry for investors over the next couple of months is going to be the debt ceiling fight, the looming possible default. How much attention are you paying to that? And I guess how big of a risk do you see that being to the markets going forward?
Yeah, so on our Systematic Edge multi-asset team, we were having a discussion about that. A lot of us have been in the industry for a while. Remember back in, say, August 2011, when it really came to a head. So August 3rd, 2011, it was a great day. My son was born. That was also when they signed the Budget Control Act, raising the debt ceiling. Of course, 2 days later, S&P decided to downgrade the U.S. debt because they didn't like how that standoff went. But we learned a lot from that experience. We learned that the Treasury kind of had a backup plan. The Fed had a backup plan as well, as far as what would they do. No, it doesn't seem all that possible to really prioritize payments, all of the payments, but they probably could prioritize payments on the debt. And the Fed, back in the 2013 minutes, if you read through those, it said that they wouldn't want to, but they were willing to step in, maybe buy up the government debt if it did look like they were going to default on it. So to me right now, it looks like it's maybe a game of chicken, but played by turtles that are moving very, very slowly towards each other, one in New York and one in LA. So this will play out over a long period of time.
I can't unsee that. A game of chicken played by turtles, man. Next streaming series coming up. Brian, guest after guest here buried the 60-40 last year. You say it could be poised for a comeback this year. Why?
I think one of the reasons is that we've seen rates reset higher. There's actually decent coupon income once again in the fixed income markets. And some of the movements suggest to me that if you have a risk off day and the equity markets, yields now more often than not can actually fall. That was very different than 2012, where any risk off day in the equity markets, so you saw the S&P 500 falling, typically you saw yields rising. Now that's changed. That dynamic has changed a little bit, where people are viewing bonds as being a decent diversifier once again. And so for our portfolios here, we're actually adding some of that duration exposure for those diversification benefits and recognizing that there's actually some decent coupon income if we are indeed correct that growth is moderating and inflation is coming down. Now, if we're wrong with that, of course, we'll be wrong about the comeback tour of the balanced portfolio in 2023. But we have pretty high conviction that that's the trajectory that we're heading.